this has been a busy last 5 days or so for people running the Federal Reserve. There have been a number of Federal Reserve Board of Governors and other higher ups at the Fed who have been giving speeches to key groups or interviews talking about income inequality and also inflation, and how they not only do they want more inflation, they want inflation to run hotter, as if the inflation we already have here in the US is not bad enough. And the government inflation statistics are obviously bogus, but they said they want higher inflation, they want higher inflation targets, they want inflation to run hotter, and they also want to cut interest rates. And one of my trolls, who I blocked, was telling me, trying to lecture me, besides talking about some predictions I made in 2009, which, by the way, I've changed a lot of my views since 2009. I don't know if you believe the same things you did 10 years ago, especially after you've read 400 more books, thousands more articles, thousands more podcasts, interviewed hundreds of different experts. But he was trying to lecture me that, oh, we're not going to have inflation because then they would raise interest rates, or the market would raise interest rates. You know what? In the new normal we are in with the central bankers, they are going to at least attempt to manipulate interest rates down so they don't default, at least traditionally, on government bonds, and can make the interest payments at least for a little bit longer without higher interest rates. And so the old norms of when there isn't higher inflation, that interest rates will go up or the central bank will raise interest rates, those appear dead, at least for the G6. So the central banks that are coordinated, the developed countries. Now, emerging markets would probably be different. But to say that if there is a lot more inflation, interest rates will have to go higher, you do not understand the new normal that we're in with central banks, with rules changes and QE and all this other garbage that all these 5 or 6 major central banks have done in the last 10 years. They have put stated numbers over 22 trillion on their balance sheets in the last 10 years of QE increasing on their balance sheets. That's not counting the 40 trillion plus from China. That's not counting the $20 trillion in the Pentagon audits, the Department of Defense that's missing. So in my rough estimates, at least give or take about $65 trillion in new money and credit has been created since 2008. And a lot of it, we have global stagflation. There's different inflation in different areas. Inflation does not rise evenly. It's called the Cantillon effect. But a lot of that inflation has gone into asset prices. So I wanted to, in this live stream show, read some of the comments from the speeches from the Federal Reserve. So I'll try to go chronologically. So on May 12th, this was the first article I found for this show. Neil Kashkari, who's a crony, I think he's like another rich Democrat, former Goldman Sachs, if you're not familiar with his background. I think he tried to run for either governor of California or senator of California, and that didn't work out. And I think he's either still the president of the Minneapolis Federal Reserve Bank, or he has one foot out the door. He's looking for better private sector opportunities or political opportunities, in the Democrat realm. And he's considered like a perma-dove, He's considered a perma-dove. So he's always like, we need to cut interest rates. We need to, flood the system with liquidity. He's been that way for a while. And in this article from May 12th, updated on May 13th, he starts talking about how the Fed has created income inequality, but not the way you think. He says it's because the Fed raised interest rates. So he said in an interview last week on May 12th that, well, it says May 12th. I think they got the date wrong on the article. But anyway, it says, Kashkari said the Fed has a very powerful role to play, so something that a lot of people know, obviously, and that policymakers should take income distribution into account when assessing if they've achieved their goal of maximum employment. Kashkari's break from Fed tradition on inequality adds to the case for keeping interest rates low. So this is where this article by the journalist Matthew Bosler gets very Democrat, very biased, very Keynesian, very mainstream. So Kashkari is suggesting that keeping interest rates low is what would help poor people. But in the situation we're in now, everyone's going to get taxed more. Everyone's going to have to deal with inflation. So, and just because interest rates are high or low for one group of people, I mean, everyone's credit card interest rates, if you have credit cards, those interest rates are probably going up. Meanwhile, the banks and hedge fund managers are still able to borrow, and large corporations are still able to borrow very, very cheaply, unless you've got your credit downgraded like General Electric or something like that. And some of these other Fed presidents, whether it's New York Fed President John Williams or Governor Lael Brainard, they also spoke about income inequality with the Fed. Williams told an audience in the Bronx that widening inequality, quote, is undermining, I believe, much of what makes our country great in terms of economics, end quote. So this is, if you saw the Real Vision television special that was filmed in Northern Virginia and Washington, D.C. with Grant Williams and Neil Howe, the Fourth Turning guy, and Dr. Harold Malmgren, they talked about this as well, that there really hasn't been this much income inequality in the United States since the 20s. So things are getting to from a class warfare, gender warfare, age warfare, race. All these things are coming to a head, and a lot of it has to do with how the economy is not really as good as people are claiming. And yet today it was released that consumer confidence, keyword con, is at a 15-year high. just ridiculous. So Brainard, let me continue here with the article, said a decades-long decline in the portion of national income going to wage earners goes to the heart of the rising inequality of wealth and the unequal sharing of prosperity. Okay, well, that's part of, she actually identified part of the problem, that wages haven't risen, but the Fed, she's not taking blame that the Fed is causing a lot of this, because the Fed manipulated interest rates lower for a very long time. And now you have people like Neil Kashkari, and there's other articles I can attach. There's, I think, let me count how many articles I have from Fed members speaking out. So 1, 2, 3, 4, 5, 6 different ones. They were very, very busy in the last 5 or 6 days, whether it was the Kansas City Federal Reserve president, who actually started criticizing Kashkari. So I was shocked to hear the Kansas City Federal Reserve president criticize Kashkari for some of his comments. But the Fed is identifying some of the problems in society and the economy, but they don't understand what the root cause is. They're not looking in the mirror. So they're not saying that, oh, we haven't blown asset bubbles, and, middle class people and poor people don't own a lot of assets. And so they're blaming corporations when, if the Fed is manipulating interest rates lower, you can't blame corporations for everything. If the Fed is manipulating interest rates lower, the corporations are going to say, hey, our interest rates are cheap, let's invest in robotics, which is long-term and capital intensive. Let's do share buybacks with debt. So the Fed is the enabler. Remember, I talked about this in my short video, which, by the way, got my first 600 likes on any video and only got 7,000 views, thanks YouTube censorship, that how quickly is the U.S. national debt growing? And all these people in the mainstream, Republicans and Democrats, they yell and scream at each other. They say it's their fault, it's their fault. But both parties are to blame. Both political parties are to blame. Republican presidents, Democrat presidents, Republican-controlled Congress, Democrat-controlled Congress, the bureaucracy, which is almost all Democrat now, especially the federal bureaucracy. And also at the local and state level, especially the court system, a lot of that court system at the local and state level is almost all Democrat too as well. But my point, though, is that the Fed is basically the enabler for a lot of this. Okay? The Fed, the central bank, has allowed an enormous trillions of dollars of misallocation of capital. They've allowed these corporations to do financial engineering. So the CEOs and the CFOs can, instead of making smart long-term investments and developing new products and services and focusing on maybe opening up new property, plant, and equipment and hiring new employees, things like that in the past would have added more value to the real economy and would have driven the stock price higher. Instead, they've done financial engineering with cheap debt because of the Fed, because the Fed is the enabler, and it's created an enormous disparity. And the stock prices have gone up, and the point I wanted to make about the stock prices is I got in an argument with these chartered financial analysts, CFA people, and hedge fund people on Seeking Alpha. They are not Austrian school, they are mainstream, they are Keynesian. They probably, one of the guys was like the head of some yacht club. I think it was like this Ivy League, Wall Street asshole. And he was quoting, everything by the book, by the Keynesian book, by the Harvard Business School book, or Yale Business School, one of those. And he was basically saying that the article was about an inverted yield curve, and that the inverted yield curve doesn't matter anymore. It doesn't mean anything anymore. The stock market will keep going higher. The inverted yield curve doesn't mean anything anymore. And on top of this, let me just get some swig of water real quick. I've been talking for quite a few minutes. And that on top of this, stocks are not overvalued. And so I was telling him, well, what about this almost $5 trillion, give or take, in share buybacks? And a lot of these, the majority of S&P 500 companies their shares are not going up. Okay, it's only about 10%. I think it's even a little bit less than 10% of the total companies in the S&P 500 where their shares are at 52-week highs. The majority of companies in the S&P 500 are not flush with cash, so they don't have tons of cash on their balance sheet. Their balance sheets are doing bad. Their revenues are down. Everyone's not benefiting from this greatest economy ever that Trump is claiming. And so I was arguing with these people, and they just don't want to hear it. And then the same yacht club, Ivy League, Wall Street hedge fund guy, who's probably made a lot more money than me because he kissed the right ass or his dad got him a job right out of college or some bullshit. And he was telling me that the Federal Reserve, because they raised rates and because they reduced their balance sheet over the last year or so with Jerome Powell, although the rate hikes started with Yellen, a few of them, but because they've been on this quantitative tightening with reducing balance sheet and raising rates, that the Fed is responsible. This is the funniest thing. The Fed is responsible for recessions in the European Union, recessions in Japan, and recessions in China. I just gave up after that. After I saw him write these things, I just gave up. There's no talking. I mean, he has great paper credentials, a great paper resume. He's probably made a lot more money than me because they hired him because of his resume with like the right Ivy League degree and MBA program and the right Ivy League MBA program and all this garbage. But he was blaming the Fed for raising interest rates and reducing their balance sheet for causing the global recession, and I was just in shock. But this is the attitude that we're dealing with. A lot of financial professionals, unfortunately, have this attitude. Very Keynesian, very mainstream Wall Street people. I had a conversation with Keith McCullough, the hedge guy, on Twitter, and I didn't know this because CNBC doesn't say this, but the Josh Brown guy who's on Twitter for hours a day now, he worked for 7 years and got multiple promotions in a boiler room that got in where people were arrested and indicted for fraud. Keith sent me a copy of this guy's resume, and I was in shock. And he's on CNBC every day for hours. And this guy's basically, if he wasn't a criminal, he was knowingly working for criminals for 7 years. So these are the types of, you got to be very careful where you get your information from, and you cannot trust any one person. I was just in shock, though, at how brainwashed a lot of these mainstream Keynesian hedge fund types are. And they all have confirmation bias. They all just have really bad herd mentality. And so blaming the Fed for raising interest rates and reducing their balance sheet for causing the global economy to collapse is kind of ridiculous. Okay, so and no wonder, because of all this stuff going on, that no wonder now the data is coming out that central banks are buying gold at the fastest pace in 6 years. So Lael Brainerd, I'll talk a little bit more about some of these other articles. I'll attach all of them in the information section of this show after it's over if you want to read them in depth. But these Fed members, they have herd mentality, they have enormous ideological bias and confirmation bias, and most importantly, in my opinion, they are way too political and they are tone deaf. So they cannot they notice that there is an wealth inequality problem in society, but they will not put even 1% of blame on the Federal Reserve's shoulders. Okay, so Lael Brainerd says, quote, this is from a speech she gave earlier this week at the National Tax Association in Washington, D.C. Quote, in today's new normal, it is important to achieve inflation and inflation expectations around our 2% target on a sustained basis while guarding against financial imbalances through active use of counter-cyclical tools, end quote. So let me just add, when have Keynesians actually been counter-cyclical? Okay, because for Keynesians, in theory, I got an argument with this guy who is super political. He hated Republicans, he hated libertarians, he hated Austrian school, and he was saying, you don't know anything about Keynesian economics. So in theory, Keynesian economics is supposed to, for them to be counter-cyclical, they have to build budget surpluses, okay? So for her to even mention counter-cyclical is in good times when supposedly we have the greatest economy ever now in the U.S. The U.S. government should be building according to Keynesian economics, at least part of Keynesian economics, because there's a bunch of gobbledygook, and then Keynes just gets really weird about how he believes that government bureaucrats and PhD level people can allocate capital better than savers, and that consumer spending is what drives the economy, even if people have no savings and max out all their credit cards. But this counter-cyclical policy, when has it actually been done? I mean, in the U.S. history, once the Keynesians got control in the 20s, I don't think it's ever really been done. So the reality version of Keynesian economics that we have is they claim to be counter-cyclical, but no one has actually done that. Every time whether it's Richard Nixon or LBJ starts forcing the Fed to not be counter-cyclical, to if the interest rates are too high, got to lower them, got to do QE, there's always political pressure. And the Fed, it's a joke when the Fed claims to be independent. It's just a total joke. Okay, let me keep reading here. In what Brainerd calls the new normal, inflation hasn't moved up consistently as the labor market has strengthened, and the long-run neutral interest rate that neither restricts nor stimulates the economy seems to be lower than it was historically. So how can we have a real free market inflation rate, this neutral rate that these interventionist Keynesian or neo-Keynesian central bankers claim to find with tinkering? How can we have that when there's so much intervention and so much manipulation? How can we have that when the Bank of Japan intervenes so much in the Japanese government bond market that sometimes certain Japanese government bonds don't even trade at all? How can we do that when they're reinvesting in the QE program, talking about lowering interest rates, the market's reacting to that? Okay, so there's never going to be a free market interest rate as long as the central bankers keep trying to tinker and do more intervention. It's funny the Fed speak that they use because they claim that we're trying to do counter-cyclical, we're trying to find a real free market rate, but the Fed has a horrible track record of being wrong all the time, and then whenever they're wrong, they don't take any blame for it, and they just try to paper things over with more cheap money and credit. Okay, here we go. Here's the part where this echoes almost very similar to what the former Minneapolis Federal Reserve president said in that Bloomberg op-ed about a month ago. She says, in response, Brainerd advocated what she called, quote, opportunistic, quote, reflation, which would take advantage of any above-target gain in core inflation to demonstrate that the Fed views its target as symmetric and not a ceiling. She specifically cited, quote, core import inflation, quote, end quote, a reference perhaps to the possibility of a trade war-induced increase in prices. Minneapolis Fed President Neil Kashkari made a similar point in his own speech on Thursday. Quote, for our current framework to be effective and credible, we must walk the walk and actually allow inflation to climb modestly above 2% in order to demonstrate that we are serious about symmetry, end quote, Kashkari told the Santa Barbara County Economic Summit. Brainerd, meanwhile, pointed out that in a low-rate environment, monetary policy won't be able to restrain the financial cycle as much as previously. Quote, in order to enable monetary policy to focus on supporting the return of inflation to our symmetric 2% target on a sustained basis, along with maximum employment. We should be looking to counter-cyclical tools to temper the financial cycle, end quote. She said. It's a bunch of gobbledygook. Quote, elevated valuations and corporate debt could leave the economy more vulnerable to negative shocks, end quote, she said. I can't believe I have to read this crap. I can't believe they've gotten away with this for 10 years. I can't believe how many people are brainwashed. I can't believe how many hedge fund managers think so perversely and still have jobs. I can't believe how many investment bankers fleece their own clients and still get rich. I can't believe a lot of things. And yet, you know what? This shit has been going on for over a decade. It is truly amazing. There's almost two full separate realities at this point. Almost two full separate realities. And that was also talked about in the Real Vision television special with Grant Williams and Neil Howe and Dr. Harold Malmgren. That people are getting so bipolar that, like, the people on Wall Street just totally ignore anyone else's argument that doesn't make any, that doesn't make any sense to them from the economic background or ideological background that they have. Return Free Risk says, I wouldn't be surprised if Trump was selling tweets to pay off his debt. Peter says, it's a Trump tweet-driven market now. It's ludicrous, total clown world. Well, the tweets may help a little bit, but I think in general there's massive intervention. It's tough to prove, obviously, because we're not auditing the Fed. But anytime it looks like the stock market's about to break support levels, buying comes in. And so, you know what's funny, right? It was for 8 months, Monday through Friday, there was a manipulation Trump tweet or one of his spokespeople like Larry Kudlow or Steve Mnuchin or someone else in the Trump administration coming on and saying there's progress being made with the trade deal with China. Well, now guess what? Now that there's no progress with China trade deal and China walked away and now there's retaliation, there's escalation, now that's being sold for stocks going up. Although the stocks didn't go up today, but I think they rallied yesterday. The VIX is back down. The dollar index is up to 98, but the dollar index has had a lot of difficulty staying above 98. So we'll see if it stays above 98. It has had a lot. I think it's gotten above 98 a handful of times over the last like four to 6 months, and it hasn't stayed above 98. Gold price got smashed. Gold's down to $12.77. Silver got really smashed. Silver's almost to 14. God help the silver miners. Poor Hecla Mining. Hecla Mining's down to, it was down to yesterday, I think $1.50 per share in American on their shares on the American exchange. And their debt to equity ratios are all out of whack. So, like Nolan Watson said in his interview, and I'm surprised he said it publicly, because you know what? I know these CEOs of publicly traded companies normally do not mention companies specifically like that, because some of these guys have to sign dozens of non-disclosure agreements. So Hecla must have tried to get financing, like a streaming deal with Sandstorm Gold, and maybe the CEO of Hecla was not very nice, because I am shocked what Nolan Watson said in that public interview about Hecla Mining 2 weeks ago. How they violated their debt covenant, I have not seen. Now, I know probably some of these other mining analysts at investment banks and hedge funds and maybe Canadian investment bank mining analysts would know this better, but I have not seen, and I looked at a few different Seeking Alpha articles, any article writers mentioned that Hecla had to get approval because they had violated their debt covenants. So Hecla's in some big trouble. They maybe have, it could be 6 months. They have 6 months to fix things, maybe even less. If the silver price goes lower, probably even less. And Hecla's been around for, 100 years? Over 100 years, I think. But they've done... See, this is what the mining industry does. They get away with it. These mining companies stay alive because what these companies like Hecla can do, and the CEO may get fired, but he'll do this to save the company even though, and then he'll lie to the shareholders. And he'll do like a reverse stock split to keep the stock from getting delisted, even though the market cap doesn't change, and then the company will attempt to issue more share dilution after like a 10-for-1 or a 1-for-10 reverse stock split. Adrian, I think buying silver now, you're getting it at or below the cost of production. But silver's not an investment, though. Okay, I run into this from people like, why hasn't silver gone up a lot yet? Why aren't I rich? Because the metal isn't an investment. And it would take me too many hours to write it. I don't know if I'm going to spend the time, but most people are unaware. I think the manipulation in silver is more than just the paper price, because there's been a lot of extra silver byproduct online each year for the last 15 or 20 years. So basically the manipulation for silver it's a war on two fronts. So you have the paper price manipulation, which a lot of people know about, but then you have maybe, it could be 200 million ounces per year in extra silver byproduct online. That should not be online because the Chinese have artificial demand for the base metals like copper, lead, and zinc. And silver is normally a byproduct in a lot of those mines. So that's a lot of extra silver because the demand for a lot of those base metals is artificially high because China's just buying those things like crazy. And when the price is artificially high with the artificial demand, that means that all the silver byproduct comes online too and it gets dumped on the market. Okay, so let me read some more of these Fed comments here and we'll close things out. This is a New York Times article from yesterday. It says, Fed officials sound an alarm, worrying weak inflation could last. Federal Reserve officials are increasingly worried that inflation is too low and could leave the central bank with less room to maneuver in an economic downturn. In recent speeches and remarks, several Fed officials have expressed a strong concern that persistently low inflation may be a more permanent economic phenomenon, one that could hamstring the Fed's room to cut interest rates next time the American economy enters the recession. By the way, Danielle DiMartino Booth says that in, I think, Fed funds futures, I think at least 2 rate cuts are already priced in. She's saying that the Fed funds rate will go down at 2. The Fed strives to achieve full employment and stable price increases around 2% annually. The labor market has been humming with unemployment at its lowest level since 1969. No mention of the labor participation rate, which is still awful, and wages climbing gradually. Price gains, on the other hand, have come in consistently short of the Fed's goals and eased to 1.6% in March. I guess they're not counting oil prices because my costs for filling up my car have gone up substantially. I think it was maybe $13 to fill up my car only about 2 months ago, and now it's about almost 20. Half a tank, to fill up half a tank. The inflation conundrum is fueling what seems to be an intellectual rift on the interest rate setting Federal Open Market Committee. The Fed's chairman Jerome Powell has dismissed the weakness in price increases, attributing it during a news conference this month to, quote, transient, end quote, factors that would probably not last. On Thursday, Lael Brainerd, a Fed governor, suggested that inflation has slipped lower in a more lasting way. Quote, the fact that inflation has been running somewhat below our longer run goal of 2% may not be entirely due to labor market slack or to transitory shocks, end quote, Ms. Brainerd said in a speech at the National Tax Association's Spring Symposium in Washington. Now, one thing that Lael Brainerd has suggested is she wants the banks to increase their capital ratios, so she wants them to have more reserves, I think by 2.5%. Now, the banks, in a free market, the banks should want to do this because they should want to have more reserves because there would be no bailout, but she wants to force the banks to do this by legislation. So this is the problem with, they could screw up on the number and that might not be enough, but most of the Fed members are not in favor. I read this further in that Market Watch article that I read earlier in this live stream show. They talked about how she wants the banks to hold more reserves, but only 2.5% more. Now, if the banks are big, so the 2.5% translates to billions of dollars more, but the banks, we don't know all the stuff that they have off balance sheet. We don't even know what these central banks are doing off balance sheet. So, publicly, the Fed is not the largest holder of U.S. Treasuries. The pension funds here in the U.S. are. So, but if we had a Fed audit, we might find out that the Fed has many trillions in additional Treasury holdings off balance sheet. We don't know. This is the problem. It's tough to be a good analyst when there's no transparency. So you have to make educated guesses. Because the federal funds rate factors in price gains, permanently lower inflation would leave policymakers less room to cut interest rates and stimulate economic growth in a downturn. And when the public stops believing that the central bank can or will push price gains higher, it is more likely to accept stable wages and prices, miring inflation at its low level. It irritates me so much that they just keep repeating how disappointed they are with how low inflation is. Meanwhile, in reality, right, shrinkflation is killing me and many of my listeners here. I just took pictures on my Twitter and I put it in the Wall Street for Main Street Facebook group that these Kleenex tissue boxes, they were a 230 tissues per box like 3 or 4 years ago, and then it went to 210, and then it went to 160, and now it's down to 144, all in like 3 or 4 years. And the price hasn't changed much. The good toilet paper, the prices have gone up a lot too, or you're getting a lot less. None of these are counted in the inflation data, unfortunately. The problem is, quote, a question of our broader credibility, end quote, Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis. Okay, so he hasn't left yet. He will leave soon, though. He has one foot out the door. Said in an interview, estimates by the Minneapolis Fed suggest that inflation expectations have already fallen too low to 1.7%. Quote, that's equivalent to a little more than one rate cut that we've taken off the table, end quote. Ms. Brainerd said the Fed could prove to the public that it was committed to hitting its price goal by allowing inflation to run above 2%, quote, for a couple years, end quote. She suggested that the Fed, and good luck to the Fed then trying to rein everything back in after that. She suggested that the Fed could even tolerate a run-up in import inflation that pushed prices above the Fed's goal, a possibility as President Trump wages a trade war with China. The Fed could tolerate a run-up in import inflation. The Fed has no control over import inflation unless they devalue the dollar because tariffs are taxes, and they put higher prices in the supply chain, and the consumer ultimately pays. So if a good is being imported with a Chinese tariff, the company that imports the good may pay a higher price at the port or something along those lines, but then that higher cost gets passed on to the consumer. So I don't know why the Fed would tolerate that. It's just ridiculous. More dumb Fed speak. Quote, the Federal Reserve could use that opportunity to communicate that a mild overshooting of inflation is consistent with our goals and to align policy with that statement, end quote. Yeah, meanwhile, the Chapwood Inflation Index says inflation is already 8 to 13% per year in every major U.S. city. That's the average inflation rate for the last 5 years. And it's only going to get worse if they're going to increase the inflation. And then that's not even counting the taxes, where people's taxes are going to be layered on. Sales taxes, property taxes, new taxes I haven't even thought of yet. Okay, here, skipping ahead. On Wednesday, John Williams, the president of the Federal Reserve Bank of New York, not Shadow Stats John Williams, apparently it's a common name, and vice president of the Federal Open Market Committee, also raised concerns about inflation, saying in a speech in Zurich that global monetary policymakers could find themselves in a bind if they cannot coax prices up. Hashtag what the fuck. Oh, man. Price gains have been consistently weak in Japan and the European Union, among other advanced economies. Quote, investors view these low inflation readings not as an aberration, but rather a new normal, unquote, Mr. Williams said. He argued that central banks should revamp their policy approaches to deal with a low rate, low price gain reality, end quote. This is bad grammar by New York Times. They screwed up the quotes here. Absent such changes, central banks will be severely challenged to achieve stable economies and well-anchored inflation expectations. So they put an extra quote in there. The editing, these article writers and the editors, I don't know if they're copy and pasting or their editor who's getting paid more money is like, they're probably not doing their job. When I was in an editorial job, I mean, my boss hardly did shit. He was a drunk. Businesses, consumers, and yet he's gotten multiple promotions. And he's actually picked stocks that He recommended one stock and it crashed 40% the next day and he didn't get fired. He actually got a promotion. Businesses, consumers, and then he fired me. Businesses, consumers, and investors in the United States have all been lowering their inflation outlooks. Market-based indicators of expectations have fallen off sharply, and 2 recent Fed surveys show that both households and professional forecasters see weaker inflation over the next several years. Who the hell are they surveying? Which households, which professional forecasters are they surveying? Are they surveying people who run like small businesses? Who the hell are they? I want to see who they're surveying. It's like the Democrats with these polls, right? Who are saying that the Democrats, it's whoever the Democrat candidate is guaranteed to win the next presidential election. Well, if they're polling 1,000 people and 990 of them are Democrats, there's 1 Libertarian and 8 Republicans, then of course the poll's going to say that Joe Biden's going to win easily the next presidential election. So who the hell are they interviewing or sampling? Given the shaky backdrop, the Fed is engaging in a year-long review of its own policy strategies. It would take more than a year if they were going to be honest. Mr. Powell has described the process as one likely to result in evolution rather than revolution. So if they wanted to be honest and fix things, they would put Ron Paul in there. Never going to happen, though. Mr. Powell has described, while other officials have expressed more optimism that could drive substantial change in how the Fed approaches monetary policy, areas up for review include the way the Fed targets inflation. Right now, the Fed shoots for a 2% symmetric inflation target, meaning it is always trying to hit exactly that rate. Well, how about they show us how they calculate 2% inflation? It could instead shoot for 2% on average, for example, meaning it would offset low inflation today with higher inflation later. So if they're only getting 1.6% or 1.7%, which was said in one of the articles I read, then they could shoot for 3 or 4. And the averages would even out, according to them. But some Fed officials are encouraging a different type of shift. Mr. Kashkari said on Thursday that merely tweaking the Fed's framework would not be enough. The Fed itself has been the problem, he said, by raising interest rates too aggressively in this economic expansion, even when the labor market has room to grow. In effect, the Fed may have unnecessarily muted inflation. Oh my God. It is amazing how brainwashed these guys are. And these guys are making like big salaries. It is nuts. They stopped inflation with the interest rate rises. Yeah, a real Paul Volcker with a couple 8 quarter point hikes in 7 or 8 years. Okay, back to the stupid article. We'll finish this and then I'll answer listener questions and comments. I can't read all these articles. This is just incredibly frustrating. Hopefully you guys enjoyed some of the humor I've been mixing in. And you tolerated some of my grammar mistakes because I'm just too pissed off. Federal officials have pledged to be patient before making further increases, and all of them want to stand pat until economic data push them in one direction or another. Mr. Kashkari said he did not think that a rate cut or 2 or a tweaked framework would be enough to restore the Fed's credibility. Quote, the bigger, more important question is, if we were not willing to allow inflation to climb above 2% before raising rates this time, why would any price level target be credible in the future, end quote. He said, we need to own up to the fact that we're responsible. It's not a mystery, end quote. So while the jobless rate, I forgot this paragraph here because I was so stressed out I skipped right through it. While the jobless rate is historically low, again, that's spinning things and not counting the labor participation rate, workers have been coming back into the labor market, keeping monthly payroll gains near 200,000. Yes, they're not high-paying full-time jobs, though. If you dig through the data, it's actually even worse. That is a surprisingly robust level. A decade into the expansion, the Fed has lifted rates 9 times since 2015 to preempt higher prices and amid labor market tightening. My estimation there of 7-8 rate hikes was just a guess. Offhand, I didn't remember the exact number. So I'm not even sure if that's the exact number because I don't know how well the New York Times, the toilet paper of record, fact checks anymore. Hey, Benjamin, thanks for tuning in to my rants. Hopefully you enjoyed them. I would take a look at some of these Fed speeches if you have the time. Some of the stuff in there is pretty ridiculous. Maybe you can make a drinking game every time they say low inflation. Since it is the weekend, right? It's Friday. It's after 5 p.m. here. Can make the low inflation quote phrase drinking game. No, Watchman, I did not listen to Macro Voices this time. I'll try to get to it. I don't always listen to them. I've been cutting back on some of my financial research just a little bit. I've been listening more to Rollo Tomasi's podcast. I find that stuff interesting. Yeah, Luminary, it's just a question of what's going to be the economic landmine that triggers like the domino effect or the daisy chain. And it could have already happened. So the Steve Mnuchin Christmas Eve announcement there with the plunge protection team, something bad could happen then, and he mishandled it. He handled it very poorly. Luminary Wind says consumers are broke. I would agree. I might do a separate video on that. There's a bunch of articles that have come out, and yet here we have the data that came out today that consumer confidence is at a 15-year high. Weird, right? That's dystopian. Yeah, the Fed are the drug dealers. They are the enablers. Or they're like the parent who knows that like their kids are like bad drug users and won't help get them clean. Just going to let them ruin their lives. I'm surprised that Michelle Caruso Cabrera still works at CNBC. I mean, she's been there a long time, but she's an open conservative. I have a signed copy of her book, and I used to speak to her in emails. She's a pretty cool chick. But I'm surprised, considering how political CNBC has gotten. I don't think they really have any more conservatives who work full-time there, like on their TV section. I think they got rid of almost all of them. She's like the only one I know. But I guess she has tenure there. I'm surprised she still works there. I'm surprised they haven't gotten rid of her yet. But almost everyone else who's like a talking head on CNBC is like pretty hardcore Democrat, and a lot of the reporters, and I'm using air quotes there, actually hate capitalism. I've spoken to some of them. Well, this is, if you're holding physical gold and you're expecting the price to go higher and you're expecting $2,000 an ounce gold, like I said, it's not an investment. So if you buy gold cheap and you have a long-term view and you buy a little bit each month, your dollar cost average, again, this is not financial advice, just my opinion. But then you're taking a long-term view and you're not trying to time the gold price perfectly. And that's the mistake that most people make, is they try to time the silver price perfectly. They try to time the gold price perfectly. The mining stocks and the royalty and streaming companies are where you can do that better. But the manipulated paper price environment actually benefits the 5 largest royalty and streaming companies because they have good balance sheets and cash flow and diversification to do deals in this environment. Now, this is just hypothetical, but I probably wouldn't be doing deals with Hecla, especially when their stock price is almost down to $1. That's a big red flag for any company. But someone, hopefully not Sandstorm Gold, will probably do a deal with Hecla, and then that deal might end up going bad and then having to be written off. Crash 845 nailed it. Jason, this is a marketing campaign. They need to drum the inflation message into the minds of the dumbed down masses. You got it, man. You got it. So the Fed is trying to telegraph things, and unlike the troll who I blocked, the Fed manipulates so many markets now, and it's all interventionist, that if they want to try more inflation and lowering interest rates, they can do it. I'm not saying it's going to work out well. I'm saying they could try it, though, because they can pull levers, they can manipulate markets, they can do all kinds of interventionist economics, central planning, and get away with it. Most people won't call them out on it. Well, here's the thing about mining stocks. So there has been some big winners in mining stocks. So there's been Kirkland Lake Gold, which is Eric Sprott's company, and then there's been West Dome, which had a big discovery. And There's been one or two other gold miners that have done pretty well, but in general, like more than 50 gold miners have and silver miners have done absolutely poorly. So if you can pick out, again, this is not financial advice, just my opinion. If you do good research or you follow the right mining stock newsletter writer and you don't put too much money into mining and you have like a couple bets, small bets, you can maybe make some decent returns. But if you invested in Kirkland Lake, Wesdome, and then other gold and silver miners, you didn't do well in the other gold and silver miners, but some of the gains from Kirkland Lake and Wesdome may have offset that. In general, the business models for the larger royalty and streaming companies are better. The smaller royalty and streaming companies that are smaller than Sandstorm Gold are selling. They do have growth in their portfolio, but they've had to sell an enormous amount of equity to get that growth. So they had to pay a very high price for the growth. Like, for example, Mavericks Metals, which has a good amount of growth, they had to give almost 30% of their total equity of their company to Newmont Mining to buy a royalty package, and the royalty package probably wasn't even that good. I don't think there was a lot of immediate cash flow assets in there. There's some good growth assets. I think they got a royalty on Agua Rica, like a 2% or 2.5% royalty on it. So long term, if that mine gets built, that'll be a good source of cash flow for them. But it's not just about buying an asset, it's about what you paid for the asset. So if you had to give up 30% of the company to buy those things, then it might not have been worth it. The average person won't care about this. If you're a long-term investor, you care. If you look at the fundamentals or financial statements and balance sheet of the company, you'll care. But if you're a stock trader, you're just going to look at the chart and see, oh, Mavericks Metals looks good. If you're a day trader or a swing trader, oh, Mavericks Metals, the stock chart looks pretty good in Mavericks Metals. You're not going to look at the operational parts of the company, the balance sheet, the fundamentals, and see that management has done some very dilutionary deals for a while now. The smaller royalty and streaming companies, if their shares crash, though, I would expect them probably to be hostile takeover. There would be some type of buyout. And some of you guys talked about exploration companies. Those are big bets. I mean, unless you have a geology background or you track like insider purchases for some, because there's websites that track insider buying for some of these juniors, or you pay for the right paid newsletter, the juniors are just very difficult to get winners on. A lot of these juniors right now, they're not going to be able to raise money to build a new mine. Especially if the gold price was going up to $1,400 or $1,500, there would be more money able to drill and build new mines, but that's not happening. There's very few new mines, and it's very risky building a new mine in this environment unless it's a small mine and it doesn't require that much capital. And what most people don't understand about a mining company is if it's a big mining company and they're trying to grow, they have to often bet almost the whole company on a big mine. So they have to take out a lot of debt. They have to put a lot of their cash on the balance sheet. They have to sell shares, and it's very, very risky. And then there's the maintenance capex, which all the property, plant, and equipment stuff, even if the metals price is not rising or going down, the mine still has to be maintained. And that is very, very expensive. G-Bob, well, you should have been notified. If you clicked the bell, you should have been notified, but YouTube doesn't want me here anyway. Okay, well, we're longer than I expected to go. I didn't read all the articles for you guys about the Fed speeches and the Fed comments, but I will attach them in the information section after the show is over. And the bottom line is they are conditioning us, Pavlovian responses. They are conditioning us with Pavlovian responses now to prepare for more inflation. So everyone get ready to start barking when we hear the bell. Okay, bye. Everyone have a great weekend. Bye.